Bismillahirrahmanirrahim. Assalamu alaikum. Viewers, you are welcome in this video. This video is a continuation of my previous 4 videos on a topic, ratio analysis. In my previous 4 videos, I have covered liquidity, solvency, profitability, and efficiency ratios. In this video, I will talk about the 5th category of ratio analysis called coverage ratios. Viewers, coverage ratios measure a business ability to service its debts and other obligations. Analysts can use the coverage ratio across several reporting periods to draw a trend that predicts the company's financial position in the future. A higher coverage ratio means that a business can service its debts and associated obligations with greater ease. Key coverage ratios include the debt coverage ratio, interest coverage ratio, fixed charge coverage, and EBITDA coverage, earning before interest, tax, depreciation, and amortization coverage. Viewers, when we talk about coverage ratio, a coverage ratio is any one of a group of financial ratios used to measure a company's ability to pay its financial obligations. A higher ratio indicates a greater ability of the company to meet its financial obligations, while a lower ratio indicates a lesser ability. Coverage ratios are commonly used by creditors and lenders to determine the financial standing of a prospective borrower. The most common coverage ratios are: number 1, interest coverage ratio. Interest coverage ratio refers to the ability of a company to pay the interest expense only on its debt. The second one is debt service coverage ratio, the ability of a company to pay all debt obligations, including repayment of principal and interest. The third one is cash coverage ratio. It refers to the ability of a company to pay interest expense with its cash balance. The fourth one is asset coverage ratio. It refers to the ability of a company to repay its debt obligations with its assets. Viewers, on your screen you can see the coverage ratios, interest coverage ratio and its formula, debt service coverage ratio and its formula, cash coverage ratio, and asset coverage ratios. All ratios I have mentioned the corresponding formulas regarding each coverage ratio. So let's start with interest coverage ratio. The interest coverage ratio, in short we can write it as ICR, also called the times interest earned. It evaluates the number of times a company is able to pay the interest expenses on its debt with its operating income. As a general benchmark, an interest coverage ratio of 1.5 is considered the minimum acceptable ratio. An interest coverage ratio below 1.5 may signal default risk and the refusal of lenders to lend more money to the company. The formula of interest coverage ratio is operating income divided by interest expense. Let's have a look at the example. A company reports an operating income of $500,000. The company is liable for interest payments of $60,000. So we will simply divide operating income by the interest expense. This will give us Interest coverage ratio 8.3. Therefore, when it comes to interpretation, it means the company would be able to pay its interest payment 8.3 times over with its operating income. The next ratio is debt service coverage ratio. The debt service coverage ratio, or in short DSCR, evaluates a company's ability to use its operating income to repay its debt obligations, including interest. The debt service coverage ratio is often calculated when a company takes a loan from a bank, financial institution, or another loan provider. A debt service coverage ratio of less than 1 suggests an inability to serve the company's debt. For example, a debt service coverage ratio of 0.9 means that there is only enough net operating income to cover 90% of annual debt and interest payments. As a general rule of thumb, an ideal debt service coverage ratio is 2 or higher. The formula to calculate debt service coverage ratio is operating income divided by total debt service. Let's have a look at example. For example, a company's financial statement showed the following figures: operating profit 500,000, interest expense 100,000, and principal payments $150,000. When we put these values into a formula, so debt service coverage ratio will become 2. It means the company would be able to cover its debt service 2 times over with its operating income. The next ratio is cash coverage ratio. This is one more additional ratio known as the cash coverage ratio, which is used to compare the company's cash balance to its annual interest expense. This is a very conservative metric as it compares only cash on hand, no other assets, to the interest expense the company has relative to its debt. The formula of cash coverage ratio is total cash divided by total interest expense. Let's have a look at the example. Consider a company with the following information: cash balance $50 million, short-term debt $12 million, long-term debt $25 billion, interest expense $2.5 million. So cash coverage ratio, from the given available data, we will take only the cash balance $50 million and we will have to divide by the interest expense, which is 2.5 million. So here it comes 20 times, meaning the company can cover its interest expense 20 times over. Since the cash balance is greater than the total debt balance, the company can also repay all the principal it owes with the cash on hand. The next ratio is asset coverage ratio. The asset coverage ratio evaluates a company's ability to repay its debt obligations by selling its assets. In other words, this ratio assesses a company's ability to pay debt obligations with assets after satisfying liabilities. The acceptable level of asset coverage depends on the industry. An ASR, or asset coverage ratio, of 1 means that the company would just be able to pay off all its debts by selling all its assets. An asset coverage ratio above 1 means that the company would be able to pay off all debts without selling all its assets. The formula regarding asset coverage ratio equals to total assets minus intangible assets, then minus current liabilities, and from current liabilities we need to subtract short-term debt, and this resultant figure we need to divide by total debt obligations. Let's have a look at the example. For example, a company's financials include total assets $170 million, intangible assets $30 million, current liabilities $30 million, short-term debt $20 million. So the total debt will be 100 million. If you look at the formula, when we put all these values, total assets 170 minus intangible assets 30 minus current liabilities 30 million and short-term debt 20 million, and then divided by total debt obligations 100 million, so this will give us an answer 1.3. The interpretation: the company would be able to pay off all of its debts without selling all of its assets. So this is very useful ratio. Viewers, the ratios we have covered in our discussion regarding coverage ratios, these are very important to assess the company's ability regarding its obligations. In my next video, I will talk about market prospect ratios. So that's the end of this video regarding coverage ratios. Thank you for watching. Viewers, do subscribe to Finance Specialist channel by clicking on subscribe button, and also hit the bell icon so that you will get the intimation of my upcoming videos. You can share your thoughts in the comment section. Stay blessed. Thank you very much. See you in the next video.